Well, good morning, everyone. Welcome to Trading a Smaller Account. My name is Barbara Armstrong. I'm a coach with Charles Schwab and delighted that you are joining me today. So what are we going to talk about? Well, this is an intermediate to advanced class, and we talk about trading strategies in this class. And we talk about a lot of different things, but, we start each year with a sum of money and we do what we can to grow that. And, when you think about why you're tuning into this, why? And I know that we all want to make money, but why do you want to make money? Or is it that do you want to generate an income? Do you want to generate a weekly income, a monthly income? Are you looking for project money? Like you want to buy a new couch for your living room, or you want money for a vacation, or you want to pay off those credit cards once and for all, gosh darn it, and never carry a balance with them again. So whatever it is that you're looking for, as we're going through what we go through today, think about how it might help you do that. Now, some people, you may be in a position where you're starting out, or you're just trying to grow the account and you don't need the cash. You may be looking at positions and saying, you know what, I've already built a giant heap and I'm just looking for ways to protect it. And that's valid too. We do a little bit less of that in this account because it is trading a smaller account, but we are very disciplined in this class about the types of trades we place and how much risk we're willing to take. So having said that, today, the focus is going to be on shorter term trades with the goal of generating income for those that may want to do that. Now, if you want to grow the account, you might say, hey, I just want to try and generate a weekly or a monthly profit that I can then reinvest and grow. And somebody's saying, I want, to be able to stay ahead of inflation. Somebody else said, I want to be able to, help my mom. And all I can say is, Carol, God love you. Being a mom myself and having one, that really resonates with me. So anyway, that's what our focus is going to be on today. And we're going to use a number of different trading strategies to try and achieve that. And we have to keep in mind, that we may have weeks or months where, our net result is negative. And so we've got to be, have a plan in place to account for all, but, eventualities. If you are not following me on X, I invite you to do so. My handle, Barbara Armstrong CS. Mike Fairborn is with us in the chat. Appreciate Mike being there. And his handle, Mike Fairborn CS, he posts some really great things. So you want to make sure you follow him. Know that options, just, before we get started here, that options do carry a high level of risk and aren't suitable for all investors. We do discuss the amount of risk we're taking when we place an options trade. Also, we are using the Paper Money software application on the Thinkorswim desktop platform, which is a brilliant place to learn and hone your skills before you consider trading in a live account. There are some nuances and differences. One is that short positions will never be assigned early in Paper Money. That can happen in a live account. I've seen it happen. So, this isn't just theoretically it can happen. It absolutely can happen. And so we discussed that. Okay. So we're going to do a very quick market overview. Kevin Horner does a great market overview 4 days out of 5 during the week. And that, is at 9:30 Eastern when the market opens. So if you want a more detailed overview, go to Kevin's for that. We're going to manage the trades and have a peek at the trades we placed on Friday. 2 of them already hit our targets and we're out. And then we're going to place some new example trades. And then I have one quick announcement, and that is that if you have never been to a live event, I got introduced to the world of trading at a live event back in 2011. It was July of 2011. And I was so excited, my car about drove itself home. And that was pre, self-driving car days. But, I love attending these now as a coach. I loved attending them as a client. They're free to attend. There's no charge for you to participate. And we'll provide at the Dallas Market Drive, for example, and the Chicago Market Drives, we'll not only provide breakfast, but we'll provide lunch. There's a really nice reception. afterwards, and we go from here's what's happening globally in the markets, here's what's happening in the country, here's how tariffs might be impacting those, and earnings season and all of that, right down to here's which sectors are showing weakness and strength, and then we might look at some examples of individual stocks. So I will be in Dallas and Chicago. I'm going home for Thanksgiving, so I'm going to miss Orlando. But I'll be at most events, through the end of the year. So would love to see you there. Please come up and introduce yourself. If you see me at one of these events, because I would be thrilled, absolutely thrilled to meet you. Okay. So having said that, and you know what, you do have to register. So, and register quickly. The reason you're not seeing the DC event, which is at the beginning of September, is because we're already, bursting at the seams. Okay. So let's, to do just a super quick overview, S&P 500 is like, it could hit a new all-time high today. I mean, it could pull back, but I mean, it's within a stone's throw. So, it crossed that 30-day moving average back here in April and hasn't really closed below it, except for one day here, and then it just continued all up. It kissed it and continued on up. The red line is the 30-day moving average. So it's hard to look at that as anything other than bullish. When we look at the NASDAQ, kind of more of the same. It's come back, since it crossed this line back at the end of April, the 30-day moving average, it's kind of come back and kissed it a few times and is moving on to the upside. And again, here's our all-time high on this index, and we're not far off that. We just have set up kind of a bit of a bull flag type pattern. Our Russell, moving nicely to the upside. That uptrend appears to be continuing. And then the Dow on Friday hit a new all-time high. Yeah. Yes, David, you're right. Canadian Thanksgiving is that weekend. Yeah. So, okay, is the weekend of the Orlando event. Okay. And then, so, it's kind of bullish everywhere we look. And then when we look at the VIX, I mean, we're down at 14.3, which is, so this has been trending down, which makes sense when the other major indexes are trending up, right? So, and then, which sectors have been strongest of late? Well, look at this. Technology, communications, and consumer discretionary are the three strongest sectors, both over the last 4 weeks and over the last 3 months. And these are sectors that tend to lead when the market is bullish. So there's a lot of congruency here, right? Right. And if you're looking to try and trade the trend, should we be looking at bullish opportunities or bearish opportunities? Perhaps bullish opportunities, given the flow of the market. And then what sectors might we want to focus on? Well, technology, communications, consumer discretionary might be a good place to start. Okay, so one of the stocks that we looked at on Friday was Celsius Holdings, that we bought like way back at the beginning of, well, let's see, when did we buy? I wanted to say April, at the beginning of April. And we have sold several covered calls on it. And on Friday, we sold another one. Now, the stock has pulled back a little bit, but we sold the 65 call. And if you don't have this in your paper money account and you want to follow along with us, well, you won't have that 60-some% gain, that came along with us having bought it in April. But, we sold this 65 call. We've got a stop on it, on the whole position, but it's pulling back a little bit today. But you know what? Part of the reason we sold the call on Friday was we thought it might pull back a little bit, and we were okay with that. So that's just kind of rolling along, doing its thing. Then we added a position on Newmont Mines, which is in the industrial sector. This is a gold mining stock, and gold has been hitting gold has been very strong. And so with this one, it has been uptrending, kind of was consolidating, and it was breaking out, kind of a diagonal resistance breakout was what we were seeing on the chart. And so we bought some shares of stock and we put in a target based on the Fibonacci's up here and our exits here. Excuse me. So it's kind of rolling along, doing its thing. We placed 2 additional trades on Spotify. And Spotify, as many of you know, is a music service provider. And so we thought we'd compare and contrast doing a short put vertical. So this was on Friday when we placed this trade. Oops. So, and so we sold a short put vertical here, wanting it to stay above. And then we did a long call vertical at 690 and 695. So it was probably trading just under 695, wanting it to stay above 695. Well, of course, we had Powell speak on Friday, and there must have been some interesting things happen in the market because we hit our targets on both of these. And this may be an example of a paper money exit, but just I've been gone for the last 6 weeks. And so if you are a little bit rusty on how to calculate what, the net results are. I didn't test this. Let's hope it's working okay today. I usually test it now before I start the class because there's been some weird things happening with my drawing tools. But I'm optimistic. So if we look here, we did this short put vertical on Spotify and we got paid $2 for it. And we put that in, during class. And then just a few hours later, we ended up out of that trade for 35 cents. And so if you want to calculate your return on your risk, how would you do that? Well, you'd say, okay, I got paid $2.05. I bought it back to 2.05. I bought it back for 35 cents. So the net was I made $1.70 a share. And if I made $1.70, what was I risking? Well, I was risking $5 to get in, right? The difference between the strikes minus the 205. So I was risking $2.95. So my return on risk was, and this is not counting commissions, $1.70 divided by that 295. And so that turned out to be 57%. And that's extraordinary. That isn't a typical return for a short put vertical, but that's how that one worked out. And then if you said, well, we were going to compare that to the long call vertical, and that was placed here. We placed it right after, and we paid $2.55. So how much could we have lost on this trade? We could have lost $2.55 a contract. So we could have lost $510. But if we look at this on a per contract basis, so we paid this much, we sold it for $3.95. So we sold it for $3.95. We paid $2.50 to get in, $2.55. So we made $1.40, if my math is correct. And how much were we risking? Well, we were risking the amount we paid to get in. So on a contract basis, we made $1.40 and we were risking 255. So when I say, you know, there can be risks, I mean, we could have lost 100%. And so this was a 55% return. So the returns on this were pretty similar. And that's somewhat unusual from a percentage basis. Here, we're often seeing something like 18 to 30%. Yeah. Yeah. And so, you know, I didn't place this in my live account on Friday. So I don't know if this was kind of more of a paper money fill or not. But we ended up out of the trade, both of these trades, and these were the returns. And then from a dollar perspective, on this one, we made 280 less commissions because we did 2 contracts, but we were risking more, right? So, and on the short put vertical, we made 170. Whoops, yellow smello, 170. So those two worked out nicely. It added what, $450 to our account, you know, our virtual account. So we could go out and have a really nice, expensive dinner with a special friend with a nice bottle of wine for that. Or for some people like that, that could be a car payment. It could pay a lot of bills, you know, but we could have ended up losing on that trade. But, you know, if we look at it, if we come to Spotify now and we say, well, it bounced and we had this Harami pattern, but could we kind of do a wash, rinse, repeat? Because the market may have been doing some weird things with the Fed speak and all of that. You know, could we come back? And if we did another short put vertical, where might we want to put the strikes? Well, I still think, well, the low on this day was 692. Sorry, the low was 685. So we could maybe do 685. If we could get enough premium, it would still be nice if we could sell the 680, right? Right. So let's come to the trade tab. And one of our challenges with this was that when we looked at the monthlies at September, we went to a $10 wide spread on the put side if we went below for the monthlies. So if we come back to these weeklies, could we, you know, is there a chance that we could do the 680 and the 675 again? We've got a delta of 32, which means the probability of it being in the money is about 35%, according to this, you know, which means you've got a 65% chance of it expiring worthless with where the stock sits right now. And you've got over $20 worth of wiggle room in that. Our goal with a short vertical is for it to stay above the short strikes, right? So if we looked at selling our vertical at 680 and 675, we'd get $1.50 credit for that. Now, if you do a lot of these, you know, if we could get $1.55 and we're risking $5 minus that, so we're risking $3.45, that's a 44% return for a trade we'd only be in for 18 days. And so if we go, well, I'd be willing to take that risk. I'm going to come to single order, make it first trigger sequence, and I'm going to put in an exit by creating an opposite order saying, hey, when this is worth, and you know, in this class, we're using 20% as an example. You might want to use 10. You might want to let it expire worthless. You know, or you might say, hey, if we meet on Friday and we've already got 50% of our max gain, maybe we decide to take it. Just because you put this in doesn't mean you can't change it. So we're going to come down to make this good till canceled. And again, we want to read this to make sure that we didn't inadvertently make this 10. We're risking 345. Now, why don't we do 2 contracts? Well, because this is a $30,000 account. We don't want to risk more than $500 on any one trade. And so if we did 2 trades, we'd be risking $700. That's too much. So we're just going to do 1. And that's how we're choosing that quantity. Okay, so we're going to come down here to short put verticals and hit send. Okay, now one of the things we look at, and I didn't go over that because, you know, for those of you that are regulars, 714,000. This does trade on average over 1 million shares a day. Do we have a tight bid-ask spread? So is it less than 10%? So that would be less than $1.20. Well, it's 75 cents. Does it trade 20? Do we have 20 contracts or more on the books? Yes. So we've got some liquidity. I mean, we'd be happier if we had thousands of contracts on the books, but this is a weekly. And so we tend to have less volume. Like when we come to the monthlies, you can see we've got hundreds of contracts. And if we came to the monthly and we said, and it's interesting because when we go up, we now have $5 wide spreads. Could we do, it's at 702. If we're bullish on this, could we do the 700 strike? So we have over 2,000 contracts, and maybe the 705. And we have 11 contracts on the books, 10 contracts traded today. So let's just see. Our bid-ask spread is, $1 on a $30 strike. So this is $2.55. So, and we're risking, how much? We're risking $2.55. We could lose the entire amount. So we're going to do 2 contracts like we did on Friday. So we're risking just over $500. And with these, our goal has been to make 50%. So we're going to say, again, we're going to put a target in. And the deal is if we're up 50% or down 50%, we exit. We're putting in the target. Why not put in the exit? Because sometimes when the market first opens, there's a lot of volatility. And what I have seen in my live account is that there have been times when I have been stopped out for way more than a 50% loss, and then the market settles down and I wouldn't have been stopped out at all. Now, that may never happen to you. And you may say, well, that was like a bluebird event or like a black swan event, maybe, but I'm trying to kind of come up with ideas for trading plans that might work for you in the real world. So that's why we just put in the target, because, if the market has some volatility to the upside and I end up nicked out for a 50% gain, well, I can fall on that grenade, and I'm happy to do that. So, but I just don't want to get hurt the other way. So for a trader, this is kind of a conservative way of doing it, but then how do you know when to get out? Well, every day. So this is an active trading class. We're going to put this in our long call vertical group, and we're going to compare this to the short put vertical. We're risking 510. The most we can make is 490, and we're saying we don't want to be greedy. If we can make half of that amount, we're happy campers. And you might say, like, somebody is going to smack you. Somebody is going to smack you. Even if we're able to achieve that gain by the 19th of September, I mean, that's, not too shabby. So it's because and this is why I've set this, because I used to be really greedy with these. Like if I could make 100%, gosh darn it, I did not want to leave any money on the table. And you know how often I made 100%? Like almost never. Almost never. It was so frustrating. And I'd be up 25, 50, 60%. And then it'd be 50, 40, 30. And now I'm losing money. And it's like, And I thought, well, what if I just set a more reasonable target? Okay. So one of the things that, you can, in the bottom right corner of your screen, there's a little tab there for you to subscribe. And what you're subscribing to is the Trader Talks channel from Schwab Coaching. And if you didn't see us place these strategies, these example trades on Friday, you can go back and rewatch this one. It has been posted. But if you are new to these strategies, Jerry, I'll show the spot short trades again, but it was the same strikes as Friday's class. It was, Oh, I didn't write them down. It was something 80. Okay, so we're going to go to playlists. And we're going to come down to these trade management mini sessions. Now, I have taken a hiatus, but I will be adding to the candlestick pattern. So I teach a Getting Started with Technical Analysis on Tuesdays. If you haven't joined me for that, consider this your invitation. But I'm just doing all these really short videos. They're somewhere 3 to 5 minutes long. Kind of what's a shooting star, all these different patterns. Do they need confirmation? How are they created? And I'll show you a couple of examples. But the reason I brought this up is if you're new to short put verticals, here's an example trading plan. And you can watch this and then use this as a way to create your own trading plan. And then here's one for long call verticals also. And then there's one for buy right covered calls. And, you know, Celsius Holdings, we started as a buy right covered call. And then there's a stock investing one also. There's a whole bunch of them in here. So if you want to do some binge learning, you may want to check that out. And then right at the bottom, I've got a bunch of short ones on just how I customize my charts and stuff like that. If you're new, you're welcome to come. And yeah, so, you know, Kachuta, I may be mispronouncing your name, and if so, I apologize. But, you know, here's a bunch of short videos on just how I customize my charts and how I customize the monitor tab and all that kind of stuff. So it's trade management mini sessions. And I put a link in at the, in the show notes at the end, and I can put a link in here also. But yeah, when you subscribe, you know, you can, this is where I come to watch webcasts. Okay, so that's that. We've placed our first 2 trades. Now let's go and just, someone asked what, if I could review that. So here's our short put vertical on Spotify. And then you can see here, we haven't quite got in. The price has gone up on our long call vertical. So we say, okay, you know what? I'm going to just cancel and replace this because I want to make sure it gets filled. So I'm going to send that in again. Long call vertical. And we're going to compare it. For some reason, the notes don't stay. Compare to our short put vertical. Okay, and hopefully that one will fill. I'll make sure it fills after the class if it doesn't fill during the class. So let's come and look at Goldman Sachs. Now, this is one that back, you know, before I took my extended 2.0 project leave, we traded Goldman Sachs a lot. And, you know, because it was moving quite bullishly, as you can see. And, you know, it kind of has come up here and started consolidating a bit, but now it's moving again. So we had, you know, and I'm drawing a line here just to say, if I see a support level, where might that be? Maybe around the 715 level. And is that too far away for us to be able to get enough premium for it to be worth our while to sell a short put vertical around 715? You know, there was an opposite order on the long call vertical. It was to exit at like 375, John. So if you come and look here, here's our entry. And I don't know why it's not filling because it's now trading at 257. So that should fill. And then here's our order to close it at 375. Okay, so, and this is waiting to be triggered. There was just a question in the chat. Okay. Okay. So coming back to Goldman Sachs, we want to come to the trade tab and say, could we come to this 715? And it's kind of a long way out. So let's come to 25 strikes. So here's the 715. We have 310 contracts. It's at a delta of 28. So you've got a 70% chance of it expiring worthless because you've got a 30% chance of it being in the money at expiration. We have a 20-cent bid-ask spread. So, you know, we're cool with that. And then we're going to say, well, we want to sell, and for some reason I'm having trouble altering my strikes. So we want this to be $5 wide. We get $1.22. Is that enough? Is the next question. So we have enough volume here. On average, it does trade more than 1 million shares a day. We've got enough volume on the options. We've got a 20-cent bid-ask spread. So check, check, check on that. So $1.22, I'd have to divide that by 3, $1.22 divided by 378. It's a 32.3% return potentially for a trade we'd be in for 25 days. So what our goal, if you go and you look at that example trading plan, just to give us an apples to apples or try and provide an apples to apples comparison is, well, if we're in it for 25 days, we'd want a 25% return on risk. If we're in it for 50 days, we'd want a 50% return on our risk. And, and if we're saying, oh, we could get 32, well, that meets our criteria. So we're going to come down to our single order, make it a first trigger sequence, right click, create an opposite order, say, hey, when this is worth about 24 cents, this is a limit order, so it'll trigger an order to exit if it becomes worth 24 cents or not, or less. Confirm and send, so we're risking 380 to make 120, and we're going to put that in our short put vertical group. And then we're also going to look at a short call vertical. And sometimes people see this, and there is a survey in the chat today, and they'll say in the surveys, it really drives me bananas when you do this. Like, just pick one. Tell me which one is best. But, this is a teach a man to fish thing. And so I think it's sometimes interesting to compare, because when you look at this and say, okay, I have strikes here at 7:15 and 7:15 and 7:10, and it expires September 19th. So as long as it stays above this 7:15 strike, we have a profitable trade. If it goes up, we're good. If it goes sideways, we're good. We've even got, here, $27 worth of wiggle room. Like, that's a lot of wiggle room. Okay. So where with a long vertical, now I try and do these long call verticals less aggressively. What do I mean by that? Well, if it's trading, I try and create a sandwich, if you will. And by sandwich, I mean, I tend to put the strikes, I buy the strike below where it's trading, and I sell the strike above. Why do I do that with a long call vertical? Well, then it doesn't have to move as much. It only has to move, in this case, by $2.37 if it's a $5 wide strike. And if it moves up by $2.37 and stays above that $7.45 strike, if I can do a $5 wide strike, then I'm good to go. Where if I do the $7.45 and the $7.50, I'm probably going to pay less for that, but then it has to move up another $5. Somebody's saying, why not do an iron condor? Well, with a typical iron condor, what you're doing is a short put vertical here, and then a short call vertical here. So it's really a strategy you want to embrace when something's been going sideways. Now, you might say, well, hello, this has been kind of going sideways, but the overall trend is up. And so I'm comfortable with this side of the trade, but a trader might say, if I'm going out 3 weeks or so, I'm not comfortable, that this might get run over. And now I'm in a position where I'm losing. And so why did we look at Goldman Sachs? Well, because it's uptrending. We're at 20, we're up 29%. It's been, a pretty solid performer. Yeah. And so, you could try that like in your paper money, putting on an iron condor. But if the overall market is uptrending, an iron condor is a really effective strategy when something's going sideways, but the market isn't really going sideways right now, is it? So I'm kind of trying to take advantage with the flow of the market with those stocks that are kind of following the flow of the market. And in fact, Goldman Sachs has been leading, and I didn't go over the numbers. But, when we look at the S&P, it's up 9%, year to date, where Goldman's up almost 30. So could we look at this 740, 745? So 740, and again, do we have lots of contracts? 581. How many are we going to do? What, 2? So we're looking at buying at 2 strikes wide. So 740, 745. So it just has to go up at 250. And if we're at 255 and we multiply that by 1.5, that would be 382. So we're going to do 2 contracts, single order, first trigger sequence, right click. Okay, now it's at 250, even better. 375, 375. Good till cancel, confirm and send. We're risking 500 to make 500. We're saying, hey, we can make 250, happy campers. If we get out and it continues to go up, what could we do? Well, we could do it again. We could do a wash, rinse, repeat, right? Yeah. Yeah, Vic is saying, Goldman is building a $500 million new headquarters in Dallas to support the new Texas Stock Exchange opening in Dallas next year. Interesting. Thanks for sharing that with us. Okay, so we're going to compare this to the short put vertical. So we got more comparisons coming up. Okay. So Chris is saying, is it good risk management to have multiple trades on the same stock, even if we're within our parameters for each trade? And that's a really good question. So because this is a teaching class, I'm doing that. In your live account, you might choose to only place one trade. But that's a decision that you have to make with how you're going to manage risk in your account. Some people will say, well, I own Goldman Sachs, so I own shares of stock, but when it's uptrending, so that's the part of my portfolio that I just want to leave alone and let grow. But in this income generating piece of my portfolio, if I can do some short-term trades, I'm willing to risk this much on a short-term trade, and I consider that bucket separately from my longer term hold positions, so sometimes you'll trade a stock in different ways for different reasons, and sometimes that can be at the same time. Now here's Apple. Apple has kind of been on the struggle bus, hasn't it, this year? Like, it's actually down year to date, but it's a tech stock. Tech has been leading. And when we kind of look at this huge panic pattern that was setting up starting at the end of the year, and then it hit this bottom, well, almost everything hit a bottom here around April 7th to April 9th. Then it started up trending and it's finally broken back above, kind of pulled back. So bull flag type pattern, and now moving to the upside. So you might say, well, I'm kind of cautiously optimistic. Could we do, a long call vertical here at maybe, again, that 225 and at 230? Well, let's see. If we come out to September, 225. And we've got 22,000. Like, look at this. At 230, we have 39,000 contracts. So you want to talk about a heavily traded stock. You know, this would be, you know, one of them. So this is at 290. So if we said, well, 290 times 1.5, we'd want to get out at 435 on this. And we're only going to do one contract because you might say, well, I'm willing to push it maybe up to 550, but this would be closer to 600. So we're only going to do one contract, right click, opposite order, and we're going to make this 435. Now, might this be riskier? And if so, why? Well, because this, you know, we have our expiration in September, and they usually do a big product announcement day, and the stock can move dramatically. And so that could work in our favor or it could work against us. But one thing we know for sure is we have a theoretical max loss here of 290. So even if it goes against us, we're not going to risk blowing up our account. Okay? We could just put a dent in our profit. Okay, so somebody is saying, how are we monitoring these setups? So Noodle Brains, one, I like your handle, and two, I liked the question. So with these, I said, we're going to check these every single day. So what we're going to do is I've added this profit and loss percentage column. And if you don't have that and you're not sure of how to add it, you just come up here and you type in P&L. And again, you know, if you want some other things on how to customize, you know, we'd add it right here. I've already got it. So we're just going to close that out. And we're going to look at, is this close to our 80%? And if it's up 50%, we may want to look at it. And then especially if we're up quite a bit on this and then we are down a little bit on the day, well, maybe that uptrend is about to end and we want to consider exiting the position. And with these long call verticals, we want to look at, are we close to being up 50%? Or just as importantly, are we close to being down 50%? Because that's our guideline. Okay. And you know, I cover a lot in this class. We have placed 5 trades today on 3 different stocks. We did a short put vertical and a long call vertical on Spotify and on Goldman Sachs. And then we did a long call vertical on Apple, which hasn't quite filled yet. They're saying, oh, you know, and it's just percolating. So we'll probably see that fill within the next couple of minutes. But the kind of goal today was just to discuss shorter term trading strategies as a way of perhaps generating income or growing your account. So as we wrap up, there is a survey in the chat. Thanks to Mike Fairborn for just reposting that. If you'll click on that link, there are 2 questions. So it's like 1, I hated it, 10, I loved it, and I'm going to keep coming back, and everything in between. And then there's the ability to put comments in. So if there are topics you'd like me to cover in upcoming classes, just let me know. If you like the piece, let me know. If you'd like it to be faster or slower, more trades or fewer. My commitment to you is I will read each and every comment, as will the management team. And yeah. And so you've got a voice, so feel free to use it. If you're watching this in the archives, if you've got a question or a suggestion, just type it into the comments down below. I do look at those and respond to those daily as well. And then don't forget to hit like. It moves it up in the algorithm so more people can find this content. Subscribe to the channel if you haven't done that already. And don't forget to follow Mike and I in the land of X, Mike Fairborn CS and Barb Armstrong CS. So thank you for your time, your attention, and your commitment to getting a little better every day. Get out there and hug someone you love, my friends, and I will see you in a webcast coming up soon. Up next, Mr. James Boyd. You'll want to stick around for that. Take care, everyone. Bye for now.